Welcome to Close of Business. I'm Alicia Barry. What a difference a day makes. The bulls were gone and the bears were back as optimism turned to fear within the space of hours. And after Thursday's relief rally, the Australian share market plummeted close to a 6-month low. Hopes were pinned on Nvidia's quarterly result, and it delivered with a record $57 billion in revenue, apparently casting fears of an AI bubble aside. Driven by investor optimism, the S&P 500 opened up 1.5%, but then, with no obvious trigger, investors headed for the exits, the index closing down more than 1.5%, its biggest swing in almost 8 months. Investor worries evident in the so-called fear index, back at levels last seen at the height of Trump's Liberation Day tariffs. Well, let's take a look at how things wrapped up for the week in Australia. The ASX 200 and the All Ords lost 2.5% each in the worst trading week since April. Gemma Dale is the head of investor behaviour at NAB Trade. She joined me. Gemma, risk assets were sold off at the end of the week. There really wasn't anywhere to hide, was there?
Look, it was a tricky one. You can see the market. There's a clear sentiment that we've run too hard, particularly in the US. In Australia, we've kind of given up all the gains for the year. It's been a pretty rough week, but still, you're only off 2.3%-ish for the ASX for the week. There were a couple of standouts. WiseTech was up 5% at one point, but that was very much a relief rally after a lot of negative press and some really poor results in terms of the share price for a while. Everything else, as you say, it wasn't pretty.
When we look at the S&P 500 on Wall Street, the trading range that we saw, it was a huge swing between highs and lows. We haven't seen a trading day like that since April this year or back in 2008, and we all know what happened then.
Yeah, this one feels really interesting. I mean, it feels quite different to 2008. There was an obvious catalyst back in April. We all remember what happened there. This just appears to be the market being very concerned after an extraordinary rally post-Liberation Day that we just cannot continue to see these gains, that prices have gone ahead of themselves, that we have multiples that have expanded too far, and we're starting to see real questions about the validity of some of the numbers that we do see out of the big mega caps in the AI space. So questions about OpenAI's auditor, quite specific questions about whether or not we really can justify these valuations, even though Nvidia's result was incredibly impressive. Is it enough?
And how much money is concentrated in those Mag 7 stocks, and even the associated AI story. It really is a lot in just that one area, isn't it?
It does feel like we're riding on one thing, and there has been a little bit of broadening across the market more recently, but there's very clear concentration. And I think the biggest concern for markets is, yes, we have a very concentrated S&P 500. We've talked about the S&P 493, everybody else, what they're up to, and just how much concentration we have in those top 7 stocks in particular, and even more those focused in AI. What is possibly a bigger concern is you've got a very concentrated S&P 500, but the US now makes up a vastly larger component of MSCI World than it ever has before. So it's global dollars, and the way any global portfolio that is allocated that also carries that concentration risk. And you can see investors feeling that there may be an opportunity to pull back at still quite reasonable prices, just off the highs, and perhaps de-risk some of that exposure.
And what is the risk that everyone could try and de-risk at the same time?
It's always a risk in markets, and it's a particular risk when we have, as we say, so much concentration in such a small sector. It's been incredibly impressive, and the run has been really strong. I think what's fascinating is you've seen gold run really hard at the same time. So there has been clearly some attempt to de-risk into what's supposed to be the safe haven asset, which then ran as much as 60% in 12 months. Not much of a safe haven when it's doing that kind of thing, but clearly it's been happening for a while. We just haven't seen a dramatic pullback. You're starting to see the wobbles.
What is the activity occurring on your platform telling you about the mood among investors?
Yeah, it's super interesting to look at retail investors, so people like you and me who are investing their own money, who are highly sensitive to market movements, right? They care very much about where the market goes and what it means, particularly for their retirement. Younger investors tend to have a longer time frame, less concerned, but retirees are very sensitive. What we've seen is a real lift in the cash book over the last 12 months. Investors feeling a bit nervy. More of a shift to selling, mostly trimming in things that have run really hard. So you can just see that cash book starting to grow. You can see investors waiting for a pullback. And then this week, when we've had two fairly negative days, a bit of money being put to work, right? People happy to buy the dip when it looks like something of value.
Late in the day on Friday, as expected, Japan has launched a round of stimulus. I mean, no surprise, but still significant.
Look, 21 trillion yen, it was flagged very clearly to the market and to the economy that this was going to come. I think it's more the broader risks around Japan that markets are a little bit nervy about. We saw that dramatic sell-off last year in the Nikkei when there was concern that we would see this real unwind of the yen carry trade. Is that unwind really going to occur? Investors have been really nervous about it for a long time, but debts are rising. If we see interest rates rise and bond yields continue to rise, then that repayment process is going to be much more painful. Investors are a bit concerned.
Gemma Dale, thank you so much.
Thank you for having me.
After running a dizzying rally this year, DroneShield saw its stock plunge by more than 30% in a single day last week. The sell-off was sparked by news the CEO, chair and a third director offloaded all of their shares in the counter-drone technology company. As David Taylor reports, shocked investors are now reconsidering where they stand.
Investors like Michael Bennett are still reeling from their shares tumbling.
It certainly hurt. I was watching the shares go down in value, but with this sort of thing, you have to kind of just stomach that.
Michael's held DroneShield shares for a number of years. The company supplies foreign governments with anti-drone technology, currently used in the Ukraine war.
When I started investing in it, it was 8 cents a share. It was massively undervalued. The whole company was worth about $13 million at that point in 2020. And they were publishing some good results.
DroneShield shares have surged more than 200% this year, but the stock plunged 30% in a day when the CEO and others sold their holdings.
Overall, retail shareholders have been very happy with DroneShield in the short term.
On the 4th of November, the company released more than 44 million performance stock options to staff after hitting a milestone of $200 million of cash receipts within a 12-month rolling period. The next day, it said 31 million shares had been issued in line with the Corporations Act. CEO Oleg Vornik received 15 million performance options and turned 14.8 million into shares. A week later, DroneShield told the market he sold all of them for almost $50 million between the 6th and 12th of November. The chairman, Peter James, and director, Jethro Marks, also sold out for more than 17 million between them. Experts say sales like this can affect investor confidence.
There's nothing illegal, but I think that there should be a window to prevent directors selling out the bulk of their shares, or a very large proportion of their shares, so soon after an announcement.
DroneShield told the market the share sales by the CEO and others were unrelated to the growth trajectory of the company, which it said remained strong, as highlighted in the recent quarterly market update. Directors also retain a stake in the company through vested options. But CEO Oleg Vornik holds less than 200,000 vested share options out of the 15 million he was awarded.
It is within their rights, given the system we have. And if we want to change that, we need to change the regulations.
And I think that companies in this situation can get on the front foot and really explain and communicate why those shares were sold and why the CEO and the directors have confidence in the strategies.
Smaller companies like this might find themselves in the top 200 stocks on the ASX after a big share surge, attracting more money from exchange-traded funds as they seek to track the ASX 200. A big share sell-off can then force them back out of that index, attracting more selling from exchange-traded funds that may exacerbate those losses.
This isn't a playground for innocent investors who've had no training or experience of high-tech stocks.
The old adage applies: with big risk comes big rewards. But the opposite's also true.
In some good news for workers, wages are growing slightly above inflation. Healthcare and social workers enjoyed the biggest pay rises, with the public sector leading private business. But the news is not so good for borrowers, with predictions the result could see rate cuts off the table. Samuel Young has the story.
At this popular eatery, customers are queuing for Vietnamese delight. But behind the bustle, keeping these queues on the grill is getting pricier.
The biggest cost for us is the cost of staff. It takes about 30 to 35% of our gross income every day.
That wage bill is forcing the owner Patrick Thun to make tough decisions.
The cost it gets passed on to customer, but it's very minimal only.
Wages rose by 0.8% in the 3 months to September and 3.4% for the year. Pay rises are still outpacing inflation, which rose to 3.2% over the same period. Public sector wages are growing faster than private sector pay, with state governments dominating pay rises in the most recent quarter.
This is the longest period of real wages growth in almost a decade.
Pay rises for healthcare and social assistance workers were the biggest contributor.
Up until recently, economic activity was being propped up by the public sector. But I think what we've seen in recent months is that there is a transition now underway in terms of the economic recovery, where the keys are being handed over from the public sector to the private sector.
Payroll data shows total wages and salaries paid by employers to staff rose 5.3% in the year to September, down from the 6.1% rise recorded over the 12 months to September 2024.
We want to see people getting ahead, especially because we've got to keep getting ahead because people went backwards during the pandemic.
Jenny Rocks doesn't feel like she's getting ahead. She's worked in education for 3 decades and is now the director of a community preschool.
The wage growth has almost been stagnant. Our colleagues that work in the school system, our colleagues that work in the long daycare sector have seen significant improvements in their wages, and even then those teachers' wages are still low.
She says her colleagues often struggle to live on what they earn.
At the moment there's a high level of frustration. It's constantly on their mind, how are we going to pay certain bills? For some people it's how am I going to put petrol in the car to even get to my work?
With wages remaining steady, productivity subdued and inflation picking up, economists are forecasting workers will see their purchasing power diminish in the months ahead.
We are anticipating that real wages will contract early next year, and that could just temper the recovery that we're seeing consumer spending growth.
Despite this, Besadetta doesn't see compelling reasons for further interest rate cuts.
We don't see the Reserve Bank as having any room to move rates lower. We see the possibility of one more rate cut in the second half of next year, but we hold that with a low conviction.
Sprinkle the thing off for me, please.
Back at Patrick's restaurant, he's having to mark in because he cannot afford to hire more staff.
It's been a tough year for us in Capramata here. There's a lot of shops come and a lot of shops close down as well. Most business they don't survive after their second year.
He's hoping his customers will stay with him through 2026, even if times get tough.
It saw a falling out amongst billionaires, but now the ambitious Sun Cable project has taken a major step forward. The renewable energy company has locked in an agreement with traditional owners in the remote Northern Territory, pledging to boost the regional economy and power part of Australia's energy future. Matt Garrick has this story from the town of Elliott in Central NT's Barkly region.
We really need to make this project work for the future generations.
Years in the making and signed in seconds.
This is a very historic moment. It is a very important Indigenous land use agreement.
From across the vast Barkly region in Central Australia, revellers came to watch the massive Sun Cable project get the green light from the region's Aboriginal landowners after long and complex negotiations.
This project, like 70 years, is something that we probably won't see out, but our children, our grandchildren will all benefit from this project going ahead.
The landowners agreed that a 12,000 hectare solar farm could be built on the lands of the Bamayu, Wallampiri and Jungarulu peoples south of the remote town of Elliot. It's a major step forward for the troubled project, which involves solar plants and the world's longest submarine power cable, running 4,000 kilometres between Darwin and Singapore. Sun Cable was first proposed by billionaires Andrew Forrest and Mike Cannon-Brookes in 2018. It was supposed to start work in 2023, but collapsed after the founders fell out over funding. It was resurrected the same year by Cannon-Brookes' Grok Ventures, with a revised plan to supply power to Darwin by 2030, and later Singapore.
We anticipate that at the end of this decade, we will be producing energy here in the Barkly region, and from there we'll see further progress out into Darwin and then into Southeast Asia.
Energy analyst Saul Kavanagh has been watching Sun Cable's progress.
It doesn't yet have customers, it doesn't have financing, it doesn't have proven capability and expertise to do a project of this scale.
With the Northern Territory's remoteness, coupled with the sheer scale of the infrastructure planned, he questions if Sun Cable is fully prepared for what it's in for.
Sun Cable so far have a track record of proving they can deliver headlines but not actually deliver a project.
There's scant detail on how Sun Cable's multi-million-dollar agreement with traditional owners is structured, but it rests upon proposed long-term economic benefits to a part of Australia that has long languished without a major industry.
I think it's a great opportunity. It provides jobs, training and any other opportunities.
Bringing this agreement together has been no easy feat. It's taken 3 years of negotiations between Sun Cable and around 200 traditional owners.
Now that it's been signed, advocates for the region want to ensure it's followed up with action by the company, with little relayed about how promised jobs will be realised.
They've set a very ambitious agenda and now they need to deliver on that.
The first steps now taken, with a long journey still ahead.
The cryptocurrency trading platform Binance has been making headlines. Controversy has swirled around the company since its founder, known as CZ, was briefly jailed last year after admitting to violations of money laundering regulation in the US. Last month, Donald Trump pardoned CZ as the Trump family's own crypto interests rise. I spoke with the CEO of Binance, Richard Teng, ahead of the CryptoCon in Sydney. Richard Teng, welcome to the program.
Thanks for having me.
You're here in Sydney for this weekend's CryptoCon. Now, the company has attracted quite a bit of controversy. What is the aim for this visit?
I do think that the controversy that you mentioned happens quite some years ago by now, right? So Binance itself is quite a very young company. If you look at it, we are 8 years old at this point in time. In those early days, we have made some mistakes. But what is more important for responsible financial institutions like ourselves is to acknowledge those mistakes, make amends, and make huge investments to move in the right direction. This, we would like to engage all users globally. We are the largest crypto ecosystem and largest crypto exchange on a global level with close to 300 million users. And we have Australian users. So this particular event, and I'm here, is really to connect with our users here to find out their needs.
Well, in August this year, Austrac ordered an audit into your Australian arm Invest by Bit after identifying what it says were serious concerns with the exchange's anti-money laundering and counter-terrorism financing controls. What assurances can you give that Binance is complying to stop money laundering occurring?
Well, if you look at it, we welcome the opportunity to continue to work with Austrac to uplift our compliance program. But we have made huge investments into the area of compliance in the last 2 to 3 years, right? And even before that. So if you look at compliance spend in the last 2 years, we have seen an increase of more than 30% year on year from 2023 to 2024, and again more than 30% increase for year to date in 2025. Today, our compliance headcount globally stands at close to 1,300 people. And if you look at in terms of our total headcount, that constitutes close to 22% of our global headcount. So we spend a lot of time, energy investing to that. And we welcome the opportunity to work with global regulators to make sure that we continue on that path. I'm an ex-regulator, so I can tell you that compliance is a journey. We need to continue to invest and continue to improve. And it's not only us. Is for every financial institutions out there.
Late last month, Donald Trump pardoned the founder, CZ, who had been found guilty of breaching money laundering legislation. Why did Donald Trump pardon him?
Well, I think firstly, let me just have a correction. I think CZ was found on a single count of Banking Secrecy Act, right? So look at it. We are firstly very grateful to President Trump for pardoning CZ. This fantastic news for the Binance family and everybody in crypto. People know CZ's contribution not only to the company itself, but to the entire crypto industry, right? So that's a fantastic news for all of us. And secondly, we are really thankful to President Trump for his global leadership in really championing the crypto agenda. You can see a sea change in attitude compared to the previous administration. And because of U.S. determination to make itself the crypto capital of the world, a lot of global economies are now taking crypto very seriously on that front, right? As for the pardon, I think different commentaries are out there. I think President Trump has stated very clearly the war on crypto has ended with this pardon, and we are very, very grateful for that.
Well, what role does CZ play in the business now?
Well, CZ has remained as a controlling shareholder of the company. As with controlling shareholders have shareholding rights in the company. So he maintained all the shareholding rights that he has as a shareholder of the company.
Well, Bitcoin has wiped out all of its 2025 gains. Is the crypto winter here? Are we heading for a deep freeze?
Well, I wish I have a crystal ball, right, to predict which way the market is going to move and what's the price of Bitcoin and the other tokens. Unfortunately, I don't have a crystal ball on that front. But I have to focus on the long-term fundamentals. As I mentioned, the long-term fundamentals and the drivers are extremely strong. If you look at all the different aspects of financial services now, I do think that financial institutions are now enabling their investors to trade through crypto. They are using stable coins now, which is a far superior technology compared to the traditional fiat rails. If you do a transfer via crypto, you get it almost instantaneously at a fraction of the cost, instead of jumping through 1 or 2 hoops through correspondent bank at huge cost when you do cross-border as well as domestic payment, right? So I remain a long-term bull. And I always believe that if we do experience a bear market, that's the best time to build and the best time to accumulate.
Richard Teng, thank you so much.
Thanks for having me.
Cyber attacks in the mining and manufacturing sectors have exposed the personal data of up to 3.6 million people in recent years. Experts say delays in reporting the breaches have caused further harm. The average time to report criminal breaches is a month, but some companies have taken 2 years. Rihanna Whitson and Daniel Ziffer filed this report.
Mining and manufacturing are vital to the economy, but cybersecurity is a key risk and the sectors aren't dealing with it well.
Everyone's at risk. As consumers, we're at risk. Organizations are at risk.
New figures obtained using the Freedom of Information process show 187 data breaches across the sectors since 2018, exposing the personal information of up to 3.6 million people. The de-identified data means we don't know the companies involved, but the report from industrial cybersecurity firm Sokolv shows some companies took more than a year to detect a breach and up to 2 years to report it to authorities.
And what this could lead to is additional breaches by the similar groups or types of breaches that other organizations in that same sector are unable to protect against due to them not knowing. So there are various consequences on the organization and then on the wider sector and therefore the wider Australian economy.
The federal government is currently reviewing data breach reporting rules. There's no fixed deadline for reporting breaches to the Office of the Information Commissioner, just an obligation to do so as soon as practicable. The FOI data shows mining and manufacturing companies that detected breaches took on average an extra 39 days to report incidents once detected. One operator failed to detect an intrusion for 520 days, then waited another 84 days before notifying authorities. In other cases, businesses detected a breach on the same day it occurred, but waited 30, 100 or even 300 days before informing the regulator.
We are under constant and persistent attack from cyber criminals and state actors. The threats are evolving constantly.
Our nation's cybersecurity boss says notifying authorities helps everyone.
Well, good morning, Cybercom.
Do we need a bigger stick for corporates?
I think this is an evolving space. We're constantly learning and adjusting to both the technology, the opportunities that represents, and also the threat.
Nearly 9 in 10 of the reported breaches involve personal information like home addresses, phone numbers and emails. More than half exposed financial information. Experts say forcing companies to delete personal information would remove the honeypot that's attracting cybercriminals. Manufacturing bodies didn't comment. Peak Mining Group, the Minerals Council of Australia, says its members responded in a timely manner to all legal and regulatory requirements.
Cybersecurity is part of the public conversation now. This is something that's so critically important. You know, we often, after a data breach, we go, you know, why aren't companies doing more? Why isn't the government doing more? The reality is, the public needs to understand just how real this threat is.
Yes, focus on critical infrastructure.
The CEO of cybersecurity firm Phronesis says he's aware of at least one incident he thinks met the reporting threshold, with a company decided otherwise.
Prevention is always better than cure. So the more that we can incentivise organisations to do the right things and empower the general public to own their digital lives, the less we have to worry about what happens when that data has fallen into the wrong hands.
Leaving consumers, regulators and businesses in the dark.
And that's all from Close of Business. I'm Alicia Barry. Thanks for watching.